Hey friend, Steve here with IBC Global. Today, we're going to talk about how you can set up a whole life insurance policy for infinite banking and get as much cash value as possible. We'll specifically answer a popular question, which is, should I get a whole life insurance policy with a 40/60 setup or 10/90 setup? If you're not familiar with those terms, we'll explain them in detail and I'll also go over which one gives you the most cash value. So, to kick things off with a whole life insurance policy, why people are often interested in this for infinite banking is because of the cash value. When you look at the cash value with a whole life insurance policy, there are several benefits that come with it, but there are what I like to call the three core benefits. So the three core benefits of a whole life insurance policy are as follows. First, it's a safe place you can put money. When we look at the growth rate on whole life insurance policies of our actual clients, they're producing between 4 and 5.5% per year, and those are the net returns after all insurance expenses. But it grows without any market correlation, regardless if the stock market's doing very well, poorly, same thing with the economy, doesn't matter. I see my cash value continue to appreciate over time. It's a safe place I can put money. Number two, I can access the money anytime I want. And in relation to infinite banking, there's a unique loan feature. How it works is that my money continues to compound even when I take a loan against it. So for example, if you have $100,000 in cash value with a whole life insurance policy, and we'll pretend that it's earning 5%, and you see an opportunity over here, call it real estate, that can produce you 8%, but you need $50,000 to get into this deal. Well, how people use whole life insurance and the loan feature is they'll say, I've got 100 grand in cash value. I can loan up to 100,000. I'm going to loan $50,000 to acquire that real estate deal. So I request a loan from the life insurance company. The loan comes directly to my bank account, typically ACH direct deposit. There is a cost to borrow, loan interest that goes to the insurance company. However, here's why people do it. That 5% that I was getting on the full $100,000, I still get that on the full $100,000, even though I accessed $50,000. So I continue to receive the constant compounding. That's where people are attracted to it. I get 5% here. I pay 5% on some of my money, but if the interest I'm earning on my entire cash value exceeds that, that's where people are interested in it, and then I can leverage that as a tool to earn a return elsewhere. So the second core benefit, I can access it anytime, and the loan feature is appealing to a lot of people. And then third, it's also tax-free. I should say tax-free if we follow IRS rules, which is huge. That's very easy to do though, and I'll talk about that a little bit when I get to the policy design section. So this is typically why people are interested in whole life insurance and they're interested in the cash value. Now, the most important part of getting a whole life insurance policy when cash value is your goal is to make sure you have as much cash value as possible. So let's say we've got you here, you've got some money, and you're looking to put it into a dividend paying whole life insurance policy. All right, so we'll pretend that you've got $10,000 per year that you want to put into your brand new whole life insurance policy. And when you buy that policy, you say, cash value is why I'm putting money here. So before you actually write a check, here's what I would encourage you to do. I would ask, where is your money going? Because if cash value is your goal, what I'll give you as a bit of a warning is that the life insurance industry and agents like myself are incentivized to sell you policies with less cash value, especially upfront. The higher your cash value is in the first year, the lower the agent commission is. That is just how it works in the life insurance industry, especially when we look at the first year. So that $10,000, where's your money going? It can go toward two main areas. The first is called your base premium. The second is called your paid up additions rider, often referred to as your PUA rider. Now, how do these two areas work? Well, the base premium I like to refer to as your initial insurance expense, and the PUA rider I like to call a cash dump in, because you'll feel like you're dumping money into cash. So the base premium piece, what would happen if you paid all of your $10,000 toward the base premium? Well, it wouldn't look good. Your cash value in the first year would be zero if you got a traditional whole life insurance policy. And an example of a traditional whole life insurance policy would be a product that might be called a Whole Life 100 or Paid Up at 99. It's a product where you can pay into it basically forever until you're 100 years old. Now, as you continue to pay that premium, with some products, zero shows up in cash value for the first and second year. With some products, it's for the first 3 years. If you listen to Dave Ramsey and his thoughts on whole life insurance, you may have heard him say before, you get zero in cash value in the first 3 years. So it does depend on the company and product that you select. Let's assume that your premium payment does not build any cash value in the first year. As you keep paying that premium, eventually it will build cash value. Now, why you get nothing right out of the gates is because the insurance company is overcharging us upfront for the cost of life insurance or the death benefit. So if you put your full $10,000 toward the base premium, you would have zero in cash value in the first year. And as you kept paying that $10,000 premium, eventually the cash value would build up, but it would take a long time. So if I want to access my cash value, if I don't have any there, I can't really do that. It's not attractive. What if I put the full $10,000 toward my PUA rider? How would that work? Well, dollars you pay toward the PUA rider show up in cash value. It's usually not 100%. On average, you'll see somewhere around 95% of whatever you pay toward your PUA rider show up in cash value immediately. Now, this is money that you can access. Begins compounding. This is the key to accelerating the cash value growth in a whole life insurance policy. With respect to the life insurance benefit, it will buy you some life insurance, but it's very small compared to what the base premium gets you in life insurance. So, when you look at these two areas, where do you want to put your money? The PUA rider. That's what gives you the cash value. So, what people are not aware of is that you can actually choose where your money goes with respect to the base premium and PUA rider. Many years ago, when I was living at home and sitting on the couch and playing around with the life insurance illustration software, my father's looking at it and he said, "Can I just put all of my money here toward the PUA rider?" And my answer was no, because you can't put all of your money there. The lowest that we can typically put here with the top companies in the industry, your 4 major mutuals like Mass Mutual, Guardian, New York Life, and Northwestern Mutual, is usually around 10% of whatever your total payment is. Whereas the other 90%, I can direct toward PUAs. So, 10% of $10,000 would be what? $1,000. So if I stretch the limit as much as the insurance company will allow me to stretch it and put $1,000 toward the premium and $9,000 toward my PUA rider, I would see close to $9,000 in cash value in the first year. Might be around $8,500 or so because it won't be 100% of my PUA payment, but I'll see the majority of that PUA payment immediately available in cash value. So this is an example of a policy where I am stretching it as much as possible. But when it comes to infinite banking, what we hear a lot is that instead of going with a policy that has a 10% minimum premium, one should go with a 40% premium instead, and then put the other 60% toward PUAs. If someone says that to you, I would ask why. Why are you recommending that? Because if I go with a higher base premium, I will have less money up front. That will happen to you as the policyholder. The answer that you may receive is because you should get more money long term because you'll receive a higher dividend, or you might hear you can pay into the policy for a longer period of time. The second one being that you can pay into a policy for a longer period of time. You can set up a policy with a 1090 where you can fund it as long as you want and you don't have to worry about running into any issues, depending on the company and product that you select. But the first one, the objection that we hear a lot, going with a higher base premium. Why would I do that? Often the reason why has to do with this. Dividends. I'm going to go through this in detail. So firstly, if you're paying 10 grand per year into a life insurance policy, but you're going to go with this 40/60 setup instead, what this means, first year of your $10,000, just to make this crystal clear, $4,000 is going toward the premium, and of that $4,000, zero shows up in cash value. That's a hit. You also get a larger death benefit because you have a bigger premium. Whereas with the PUA rider, $6,000, you'll see that show up in cash value. About 95% of it, so it'll be very close to cash value, very close to $6,000. And it does give you some death benefit as well. So, the example on the bottom, I am giving money up front. Why? Because the dividends are higher on base premium dollars than they are on PUA dollars. That's often the argument or the logic behind it. To be clear, I disagree with this. I am a huge fan of minimizing the base premium as low as we can because that's what corporations do, and they've maximized the cash value as an asset on their balance sheet for as long as they've used whole life insurance. The model works. I've never seen it not work. So that a 10%, 90% design, this is referred to as a 1090. Now, one thing to be clear here is my PUA allocation might be closer to 89% because I'll have to put the other 1% toward what is called a term insurance rider. So that's $100. Does not build any cash value, but it buys me a huge death benefit. And why that's important. Because remember those three core benefits to the cash value? Safe, liquid, and tax-free. Any life insurance policy can be messed up, and we can have to deal with income tax on the gains of the cash value. Specifically, happens if my life insurance policy becomes classified as what is called a modified endowment contract, or a MEC. And here's how I keep the tax-free status. Let's put it that way. Every life insurance policy has what is called a MEC limit, which is the maximum dollar amount I can pay into a policy per year without triggering that modified endowment contract. And what you will find has a direct relationship to the MEC limit on a life insurance policy is our death benefit. There are other factors that impact that, such as my age, gender, and then also the guaranteed rate has an impact on that MEC limit as well. But regardless, you'll always see the death benefit, and if we make it higher or lower, your MEC limit will be higher or lower. So with a policy where I'm driving my premium as low as I can in order to drive my costs as low as I can, adding a term insurance rider is a cost-effective way to raise the death benefit, which raises my MEC limit. It's a cheap way to raise my MEC limit so I can add more money to PUAs. Like, that's what we're doing in order to maximize the cash value. Okay, back to the dividends down here. So, what's the difference between this 1090 and 4060, specifically to the dividends? Well, if we've got you paying this 10 grand per year toward a whole life insurance policy, and you've got two options. Option one is that 1090, and then option two is that 4060. We know the 4060 is going to have less upfront. However, when you receive your annual statement from the insurance company every year, you're going to see the dividend you received. Now, dividends are paid both on base premium dollars and PUA dollars, just to be clear with that. However, you will find that a higher dividend is paid on base premium dollars compared to PUA dollars. I'm going to show you that in a moment. So what that might look at, and I'm just going to oversimplify here, is the 1090, you might see a dividend payment of $600 that you receive. Whereas with the 4060 design, it might be $1,000. If I'm getting more in dividends, doesn't mean that I'll have more cash value. A lot of times people think, yes, that's the case. However, that is not the case. Whenever you see dividends that you're receiving on a whole life insurance policy, it's important to be aware that the guaranteed interest is not included in that number. The guaranteed interest is not shown to you on your annual statement or in an illustration. We have to calculate it ourselves. But that is, call it an unseen element, or not something that is made very, very clear by insurance companies. And sometimes people are misled and think, oh, a higher dividend means that I'll have more cash value long term. I disagree, because I have not seen that to be the case. Sometimes I see it in illustrations, but I have not seen it to be the case in reality. So let's take a look. What we're going to look at is someone putting away not 10 grand per year, but we're going to look at a big number so we can really analyze the dividend. We're going to look at funding of 100K per year. We're going to look at funding a policy for 10 years. That's a total of $1 million. We're going to look at one company and one product. Keep everything the same there. What we're going to look at differently is the design. So first, we'll look at a 4060. Then we'll look at a 1090. We'll analyze the dividends. Then the net cash value growth, which is really what we should be looking at. And then we'll look at the cash value difference when we compare the two side by side. Sound good? All right, let's have some fun. So first, we'll start with the illustrations. Here's the 4060. So what am I looking at here? Well, we've got a lot going on. I'm going to start here. you've got 100K per year going into the policy. Remember that question, where is my money going? Up here is the base premium. You'll see that lined up with the name of the life insurance product. Then our PUA rider. This illustration is with Guardian, one of the 4 major mutual companies. I like the fact that they call their PUA rider a PUA rider because not all companies do that. Some companies call it AILR, LISR, EPUA, APUA, OPP, AP, all these different terms that all mean the same thing. Paid up additions, i.e. cash dump in. So anyway, of your $100,000 payment, 40% is allocated toward the premium and 60% is allocated toward PUAs. As a result, what is your first year cash value? Just about 60%, the $60,000. Now, as you continue to pay that premium, you can see how much you paid total. So by the 5th year, you paid in 500, you have 480. The 6th year, you've paid in 6, you've got 596. By year 7, you're positive. What about your dividend column? First year, 0. That's very common. If you look at year 2, your dividend, $83.70. If you look at year 10, your dividend, $28,245. Keep that in mind. Let's take a look at the same product with the same company, just designed differently. So, what we've got here, same L95 product. The difference is instead of a $40,000 base premium, you got a $10,000 base premium. Your PUA rider reads 90 grand. It's actually a little bit less. It's closer to about 89,000. The reason why is because we do have a term insurance rider attached to this policy. So this is what's called a 1-year term insurance rider. The cost does vary every year. I'm going to show you the year-by-year cost. But in the first year, it's about $1,000. So call it 10% base premium, 1% term, if we're rounding, and then 89% PUAs. What I would do with this actual policy is we could actually set that base premium to just about 9%, which would make the base premium plus the term cost about 10%, and then the rest goes toward PUAs. But I set the base premium at 10K for this example, just to keep it round. So, the dividend columns. Do you remember what year 2 was in the last example? It was $8,000 and change. Do you remember what year 10 was? It was $28,000 and change. Here, it's $24,000 and change. So just to be clear here, these dividends are lower than what we saw in the example where we had the $40,000 base premium. But look at your cash value. Instead of 60 grand, you've got 87 grand. Instead of taking 7 years to break even or get your money back, you're cash positive between 3 and 4 years. Let's take a look at these side by side, shall we? So what we're going to look at here is first the 40-60. We're going to look at the illustration we just had up, but just with a cleaner breakdown. So what we've got, 40-year-old male, $40,000 base premium, $60,000 PUA, 100K per year total. Then we see total out of pocket. This tallies up all of his annual payments. It's by year 7 where he finally has more in cash value than what he's paid into the product. And you've got your death benefit. Now, the dividends is what we want to look at here. Annual dividend. Year 2, $83.70. Year 10, $28,000 and change. Before I show you the next column, look at year 10. Your cash value is $1,119,000. You pay zero in year 11, and your cash value is $1,158,000. How much did it grow by? Did it grow by 29 grand, which is what the dividend column shows? No. It grew by $39,000. When you look at year 2, your dividend was $83.70. Did the cash value grow by $83.70? Remember to back out your premium payment. You were at $59. You added $100 to it. That would make it $159. If you add $8,000 to that, that would be $167. But we're at $163. The dividends are not showing what your cash value is actually growing by every year. What we want to look at is our net cash value growth. First year, you pay in $100, you've got $60,000 to $40,000 loss. Year over year, what am I getting net from the insurance company? Do you feel like you could be tricked by these dividend columns because they're showing you higher numbers than what your cash value is actually growing by? Yes. What about down the road? Do you feel like the dividends are shortchanging you because your cash value is actually growing by more? Maybe. My point is, the dividends do not show a clear picture of what your money is growing by. So when I hear that someone should go with a 40-60 design because it gives them a higher dividend, my response is often, who cares? Because it's not showing me my bottom line in cash value growth. I often feel like it's a sales tactic because commissions are primarily generated from the base premium. That is just how it works. 40% versus 1090 means 40% more in commissions up front. Looking at the 1090, here we go. Base premium, term rider cost, PUA, add them all together. Total outlay of $100,000. By the fourth year, I've paid in $400. I have more than $400. I've got a term rider attached. So what we like to do here is show my whole life death benefit, my term rider death benefit, and then my net death benefit, in this case, of $3.2 million. This is a 1-year term insurance rider that decreases as my whole life increases. And when I add the two together, I'm at the net death benefit of $3.2 million. And also, as that term rider decreases, I also see the term cost decrease too. The rate jumps up in year 3. That's common with Guardian products. So I usually see a slight jump there, but over the long haul, I do see it decrease. That's what I've always seen with Guardian products, both illustrations and actual policies that our clients have. Dividend. Look at this. Let me just isolate a couple of years for you. If we look at year 10, which one's higher? The one to the left. If I look at year 20, which one's higher? The one to the left. Significantly higher. But when I look at my cash value growth, which one's higher? The one to the right. Look at year 20 now. Substantially more cash value growth when I compare the two side by side. And this is on a year-to-year basis. So what I'm going to do here is just make everything else light. So when we look at the net cash value difference on the far right, this is simply showing you how much more you have in cash value with the 1090 design compared to the 40-60 design. And it's the exact same product with the exact same insurance company, just designed differently. The dividends favor that 40/60 design, but the cash value favors the 1090 design. And the last thing, just that I want to mention on this, is if you have a policy like this where you can fund up to $100,000 per year, what do you think you're committed to with both of them? With the 40/60, you're committed to the $40,000 premium per year. Whereas with the 1090, you're committed to the $10,000 premium per year. So I have a lower commitment. I can add money toward PUAs at my discretion, making it more flexible, and I have more cash value. So going back to setting up a whole life insurance policy for infinite banking, and what design should I move forward with? Personally, I like the lower base premium designs, like a 1090, because it gives me more flexibility, more cash value, and then access to my money for opportunities, for example, using it for infinite banking. I hope you enjoyed this video. If you'd like to see another video on infinite banking and whole life insurance, you can check out this one here.